Welcome, everyone. This is the Mortgage Brothers Podcast. I'm Eddie Cannell.
I'm Tom Cannell.
Okay, this is our 7th podcast. And again, I know we keep on counting. So this is number 7, everyone.
We still have a few followers, you think?
Woo! We are. I think I think every couple episodes, there's a couple new followers.
All right. I like it.
So yeah, as long as we have more followers than the episode number.
Yes.
That's our goal.
That's good.
All right. This week, everyone, this is Tom and I were briefly talking about this escrow accounts. This is not perhaps what people call exciting content.
You're likely not driving home thinking, man, if I only had a podcast that covered prepaids.
Yeah. Prepaid taxes, insurance, and interest. Now, here's the thing. Everyone probably is, whenever you buy a house, I mean, anyone who's bought a house out there or gotten financing, refinanced, they're probably always wondering, what in the hell is that? I see all these numbers on the closing statement, the worksheets, the loan estimate, but I'm not going to ask because it just sounds so, I mean, I have no one even will ask us.
Right. And then you ask some people, you'll say we have closing costs and then there are prepaids. You know what prepaids are, right? And you can tell in their voice that they don't know when they say, oh yeah. Everyone knows what prepaids are.
Exactly. And so, okay, there is no shame out there. There's no shame for not knowing what prepaids are. So when someone asks, do you know what I mean? Prepaids, you know what I'm talking about, right? It's okay to say, no, actually, explain it to me.
Right. I have no idea what you're talking about.
And then the loan officer will think, okay, I got to dig in here and explain this. So that's what we're going to do. Okay. So what are prepaids? And so every loan, go ahead.
Can I just frame this real quick?
Yeah.
So when we get borrowers that are working on a loan with us and they ask us what their closing costs are going to be, one of the first things we think of is we've got a closing cost number and a prepaid number, but how are we presenting that to the borrower? Because it's important for the borrower to know that prepaids are not costs. So from a loan officer perspective, at least from my perspective, and Ed, I think you do too, we always take a moment to say, these are your closing costs and these are your prepaids. The reason why we don't lump the prepaids into closing costs is because they are not closing costs. They are prepaid. It's like a prepaid credit card for your benefit. So that's kind of the framework here. They're getting ready to put an offer in. They want to know, they know what their down payment is. They want to get clarification on what they're bringing to close.
Yeah. So let's just say someone calls me and they'll say, okay, so what am I going to bring to the closing table? It's going to be your down payment, your closing costs, and your prepaid taxes and insurance and interest. Okay. So let's just say closing costs are $3,000. Prepaids let's just say they're $1,500. That's actually a pretty that's a pretty typical scenario if you're buying a home in about the $250 range. So yes, when the borrower looks at the bottom line, they see everything lumped all together, and it's easy for them to think of prepaids as a part of cost because it affects their bottom line.
Mm-hmm.
But so that's why it's important to talk about it. Okay, these are prepaid taxes and prepaid taxes, insurance, and interest, and that's exactly what they are. You're prepaying, and you're actually giving this money to the bank to hold in what they call an escrow account. So they're going to be holding it to you, or holding it for you. And when taxes are due in Maricopa County, for example, they are due twice a year, October and then in April. And the bank pays those taxes for you, when you have an escrow account. And then your homeowners insurance is due once a year. That premium is going to be paid by your lender. They'll pay your insurance agent. Or not the insurance agent, but the insurance company. So you prepay this lump sum of money to the lender when you close the loan. Your lender takes that money, puts it in an escrow account, which is kind of like a reservoir, like a holding tank, and then they pay those bills when they're due. And every month that you have a mortgage payment, you'll notice you have your principal, interest, taxes, and insurance in there. And that taxes and insurance portion every month goes into your escrow account. So your escrow account is swelling, and then the bills are paid, that your taxes are paid, your insurance is paid, and it goes down, and but it constantly.
So if anyone's asking, why am I, paying insurance and taxes in my monthly mortgage when I already paid an escrow, is because you're simply replenishing it. So it's constantly being used and replenished, used and replenished.
That's right. Okay.
All right. So how about prepaid interest?
Okay.
What in the world is that? That sounds like money the bank's making.
That's right.
You guys are making out like bandits. What's going on?
All right. So anytime a bank amortizes a loan, it can be a car loan. Even credit card interest. Anything that's amortized is going to have interest. Okay, your interest is always paid in arrears. Or how about this? When you make your car payment, your house payment, you're always paying the interest in arrears. So your May 1st payment is always paying all the interest due in April.
So you're only paying interest on money that you've used.
That's correct.
So think about arrears being money that's already been used for that month. You're not prepaying the interest on mortgages, on car loans, and on, I guess, Ed, you said credit cards for certain things.
Yeah, but let's just. I shouldn't have brought up credit cards, but it does work the same way. But let's just take the car loans and mortgages, the most typical, amortized loans out there, and let's say that you close a loan, your car loan or your mortgage loan on April 27th. Okay. If you close that on April 27th, you're never going to have it. You won't have a payment. Your first payment won't be until June 1st. Again, it doesn't matter if you're buying a car, buying a house, you close on that loan on April 27th, you have to pay the bank. Or how about this? Your first payment will be June 1st, and June 1st will pay all of May's interest. But how is the bank going to? How does the bank going to get the interest that's due for April 27th, April 28th, April 29th, and April 30th? Those 4 days are what you prepay when you close. So the consumer prepays those 4 days of interest. There's no mortgage. There's no payment on the loan until June 1st. So,
all right. So let's say little Johnny wants to borrow his dad's lawnmower, and his dad says, "All right, I'm going to loan this lawnmower to you for $20 a month." And he says, "Great, I'm going to use it all summer. When's my first payment going to be due?" He'll say, "Well, after your first month's use, you'll actually pay me $20. Okay. And let's say he wants to start mowing lawns May 1st. So his dad's planning on receiving a payment from him June 1st. It'll be $20. It will cover interest on the value of the lawnmower that he's lent his son. And then his son decides, you know what, I need it actually earlier than May 1st. I'm going to actually, start mowing lawns today, which is, about mid-April. It's like his dad saying, you're still going to owe me the $20 on June 1st for May, but I'm not going to be charging you for a half a month in April, in June. I'm going to actually collect that now. So that kind of works, right? The lawnmower payment will be collected in arrears every month, but for that first little bit, which isn't a full month, he'll need to get some payback for the interest since he lent his lawnmower half a month early.
That's right. When you lend money and it's in the middle of a month, or if it's any day in the middle of a month, or inside of a month, there will be interest due that won't be collected on the first payment. So it's those days of interest that will be prepaid. So so prepaid taxes, prepaid homeowners insurance. Again, taxes are you're making sure that the bank is going to have the money in the escrow account to pay the county taxes, that are due twice a year. The homeowners insurance, you're prepaying the 1 year policy, and interest, you're just prepaying the days. There's that day calculation that, of course, we just explained.
Now, I don't know, this may be another podcast, but the whole, why do we have prepaid interest? We've already talked about, but in terms of why mortgage payments are delayed more than a month. You want to talk about that? I mean, if a mortgage
Yeah.
is closed mid-April, why does the first payment have to be July 1? Does it have to be July 1?
It has to be July 1. So because the bank will not, again, because the nature of amortization, it requires that the interest is paid in arrears 1 month. So if you close if I close May 2nd, okay, there are some exceptions, but we're not going to deal with exceptions right now. Okay, there are exceptions when we close. But if you close May 2nd, May 3rd, May 4th, it can be early in a month. Technically, your first payment would be July 1st.
Because the bank wants at least 1 full month's payment.
Yeah. Did I say May? Early May?
You said early May. I messed up because I had said mid-April. But the whole point is that as long as we close a loan that is anything less than a full month, they'll always wait to charge you your first mortgage payment until you have at least a full month. So the front end non-full month will be the prepaid portion. And that's just the way lenders work. They always will have a full month's mortgage statement done. I think sometimes we sell it or we present it as a benefit to the borrower. You get to skip a month's payment, but it's really nothing that we do to build in. It's just the way the system works. So, but it's a benefit to some people. They don't, potentially have a mortgage payment for. Yeah,
and there's a lot of real estate agents out there, borrowers, and sometimes I get the feeling that they think there's some advantage of closing in late in the month or early in the month. Technically you're just playing a mind game because the interest, you're going to pay the interest. And this all settles out and the bank is,
right. The bank's not making any more money by you closing earlier or later.
Yeah. I'll have people say, I want to close at the end of the month because I want less prepaids. Okay. Well, no problem. Or I want to close early in the month because I want to have a really delayed payment. Well, as long as the borrower understands, we tell them, it isn't like they're somehow getting free days of interest.
Right.
The bank is calculating all that.
Okay. So what else have we not talked about? Does anyone ever not have prepaids?
There are people who call and say, Eddie, I don't want to have an escrow account. Okay. So this is what we're going to say here before we end. Escrow accounts can be annoying. Okay. Some people love them. Some people hate them.
I love them, by the way.
Okay. So I have a couple rental properties and I just had to go through these escrow adjustments. I get these escrow account analysis reports. And I can see when people get kind of frustrated because you get these updated payments. Every year, you might have an escrow account balance analysis done. And your payment's probably going to go up a little bit because that's just taxes. Taxes go up and your homeowners insurance goes up. You probably end up owing a little bit more. Okay. So for some reason, that's one negative reason people don't like getting those increased payments. But really, they're going to be paying the taxes and in homeowners insurance anyway, the bill. But Tom, most people I think do like them, me included, because the bank just takes care of it for you.
Yeah, it'd be a couple extra bills not to have to worry about, and the bank's not making any money on the money that's being escrowed. In terms of there are no extra fees that they charge in order to pay on your behalf. If anything, it lowers the risk of the loan, and so you may receive some benefit from having the prepaids because the bank doesn't have to worry about the property that they've loaned their money on not having.
Yeah. The bank, I'm not really sure. I can't remember if banks have non-interest accruing accounts in those escrow accounts, but I would assume the banks probably make a little bit of interest on those balances. That's probably the only things that they, but again, it's not a moneymaker for them. They don't sit there and go, oh, wait, we can't wait to escrow accounts.
When we're talking about interest on escrow accounts, what do you think their interest rate is? I mean, it's got to be
like 1%.
Oh, you think it's that high?
Yeah, well, it'd probably just be whatever the Fed rate is, and plus or minus or a margin. But I think that the banks again. Okay, so even if they make a little bit of interest, I will say, people will call me and say, I don't want the banks making interest off of my money. Okay. I mean, it's just so minute. It isn't that, I think,
I'm just going to run a very, very quick number. So if we said $1,800 at 1.5% interest, that is $2.25 a month.
Okay. That's a coffee. It's a good coffee a month.
A half a coffee.
Yeah.
So anyway,
that you could have, if you put that money in your account. Now,
that you could have working in your money market account for 0.01%.
Yeah. Now, most banks, when a borrower will ask, for, I don't want to pay the mortgage, I don't want to pay the escrow account, I don't want to pay the impounds, I don't want to have an escrow account. Most banks charge a fee to waive it. So, and most banks say in order to waive it, you have to have at least 20% equity in the home, and then there's a little fee. Okay.
And why is there a fee? Because their risk is going up.
Yeah, the risk goes up, and then people say, "Wow, what do you mean the risk is going up?" Well, what if you don't pay your taxes? What a lien will be put on, and tax liens take precedence. What if you don't pay your homeowners insurance? You have a fire. There's a claim. Or you know what I mean? You can't file a claim. You can't rebuild. The collateral that the loan was, the collateral of that loan is gone.
What happens if you're required to have flood insurance?
Okay. Yeah, good one. The flood insurance will require an escrow account. Banks, if your house needs flood insurance, you're going to need an escrow account.
Okay. That's good to know.
Yeah. Okay.
But
so
what have we not covered?
Yeah, I know there's a lot in there, and hopefully everyone gets it. And I guess, again, ask us any questions to clarify if we've missed something here.
Biggest point is they're for your benefit. They are prepaid into your account, and they are not a closing cost.
That's right. And if you paid off your loan or refinanced that loan, that escrow account balance gets refunded right back to you.
Right. Good call. Good call.
Right.
All right. Well, good.
All right, Tom, we're done. Enough damage, right, for the day?
That's right. It's called a day.
All right. See you, everyone.
All right. See you, folks.
Bye. Hey, guys. Thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to Tom at azmortgagebrothers.com or yours truly at eddie@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC, does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisor before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.